Hello everyone and welcome back. This is part 2 of the Turtle Soup Masterclass. I welcome you back. For those who are studying and taking notes, this will likely be the last video you will ever need in order to understand turtle soups. The last step after completing this lecture would be to backtest and study, and then move on to front testing and then live trading. With that being said, let's get into this lecture and let me start revealing some more secrets. The range to range model. The idea is similar to the usual range model. With this one, you are looking for a low time frame range to form below the higher time frame range when bullish and above the higher time frame range when bearish. You will soup the lower time frame range and use its risk to capitalize on the higher time frame range's reward. This is exactly how you catch high R to R trades. Higher time frame range, consolidation. Lower time frame range, turtle soup, expand higher. On the higher time frame, you will see a consolidation, turtle soup, expansion higher. Consolidation higher time frame, drop to lower time frame as soon as we go below. If you see consolidation below the higher time frame range and you see a turtle soup, you enter long. How to execute. Step 1. Identify the higher time frame bias and narrative. Step 2. Identify key levels above or below the higher time frame range. Step 3. Wait for price to take one side of the higher time frame range. Best inside the accumulation time. Step 3. Wait for price to take one side of the higher time frame range into the key level at the manipulation time. Keep in mind the opening price of the higher time frame candle. Wait for price to take one side of the lower time frame range at the manipulation time. Once again, keep in mind the opening price of the higher time frame candle. Number 5, step 5, enter with a limit at one side of the lower time frame range. Step 6, your targets. Target 1 is the opposite side of the lower time frame range. Target 2 is the equilibrium of the higher time frame range. And target 3, the final target, is the opposing end of the higher time frame range. Step 7, the stop loss. Your stop loss can be placed in 4 different ways as shown in the range model. This was just talked about in the previous slides. Please rewind and rewatch if you need to. Take a look right here. Consolidation range on the higher time frame. Consolidation on the lower time frame below the higher time frame's range. Key level right here. Not shown, however, there is a key level. Hit below the lower time frame range. TP1 at the high of the lower time frame range. TP2 at the midpoint of the higher time frame range. And TP3, final TP, the opposing end of the higher time frame range. Let's take a look at a range to range example on Bitcoin USDT. The higher time frame in this case is the monthly profile. Range in week 1 as anticipated. Week 2 of the month is manipulation. And this is exactly when you want to be looking for an entry. Consolidation on the higher time frame, which is week 1. Consolidation on the lower time frame, which is week 2. Turtle soup into a key level. Target 1, the high of the lower time frame range, which is right here, just so happens to align with the equilibrium of the higher time frame range. TP3, final TP, the opposing end of the higher time frame range. So, once again, higher time frame consolidation, week 1 accumulation, week 2 manipulation, lower time frame consolidation, lower time frame range, high and low, low breached into a key level entry, stop loss placed, targeting where? First target the high of the lower time frame range, and the final target is the opposing end of the higher time frame range. Study this image, rewind and re-listen to what I said. The lower time frame range with reversal on Thursday to cap the weekly range as anticipated. So as you can see right here, hopping onto a lower time frame, you can see another range at the low. Range low, range high. Daily open. We are below the open, manipulating below an old low, and we are within the higher time frame PD array, key level, which is represented by this blue shaded region. We saw higher time frame consolidation, range into a key level, ranging on the lower time frame, souping the low, entry TP1 where the high of the lower time frame range, TP2 the equilibrium of the higher time frame range, and TP3 the opposing end of the higher time frame range. A key to understand here is that we bought below an old low and we bought below the daily open. Keep in mind that this is the same example as this. This is the lower time frame. This is the higher time frame. So I've said higher time frame consolidation for this entire week. Range high, range low. I told you this was the lower time frame consolidation range, which is correct. However, if you want to be even more precise, drop time frames. Right here, this zone right here is represented by this. Turtle soup below, entry. Why? Because we are in a key level, formed a lower time frame range. You enter at a turtle soup and you target the lower time frame range high, then the EQ of the higher time frame, and then the opposing end of the higher time frame. In summary, it will look exactly like this. Entry, stop loss at the low of the PD array, full take profit, the opposing end of the higher time frame range. TP1, the high of the lower time frame range, which is right here. TP2, the equilibrium of the higher time frame range, which is right here. And TP3, the opposing end of the higher time frame range. What I explained right here in this slide right here is very important to understand. However, I will not dig deeper into it. If you only use the higher time frame range and implement this into your higher time frame range, and then drop time frames and only use this lower time frame range, you will still be successful. This model can be used by capitalizing on the accumulation and manipulation phases. This means you will need to know when exactly do the accumulation and manipulation phases occur. Accumulation occurs between January to April, and manipulation occurs between April to July. Keep seasonality in mind. Accumulation occurs throughout week 1 of the month, and manipulation occurs throughout week 2 of the month. Once again, keep seasonality in mind. Accumulation occurs on Monday, and manipulation occurs on Tuesday. Accumulation occurs during the Asia session, and manipulation occurs during the London session. There is also accumulation and manipulation inside every single candle. The 4 hour, 1 hour, 15 minute, etc. If accumulation expands, you use a different model, or you do not trade at all. The general idea is to catch the manipulation at the correct time. This right here means do not force any of your trades. Do not force anything. Put filters on your trades. Let's talk about another trading model based on turtle soup. The Wednesday model. This, of course, was explained by Romeo. However, I will explain it as well. Tuesday has a 70% chance of printing the high or low of the week. Write that down. There is an 81% chance that the high or low of the weekly candle forms between Sunday's open and Tuesday's London session. Very important. You need to be entering trades on specific days and exiting trades on specific days. Buy below Sunday's open on Monday, Tuesday, or Wednesday when bullish, and close the trade on Thursday. Vice versa when bearish, so that means buy above Sunday's open on Monday, Tuesday, or Wednesday when bearish, and close the trade on Thursday. Using the information mentioned above, you can anticipate that Wednesday will be a classic sell or buy day following the weekly order flows direction. If you do not know what a classic sell or buy day looks like, please rewind to the beginning of this lecture, as I have explained all of the 6 different types of candles. Variations of this model depend on what day the higher time frame PD array is hit, which creates the weekly high or low. With the Wednesday model, you are capitalizing on the weekly profile daily profile, and 4-hour candle to basically map out your trades. Having all three opening prices drawn out on your chart will be useful when trading this model. It is not necessary to draw out all the opens. However, it sure will be useful. You are using the manipulation time on Tuesday, that Sups Monday's accumulation, the range, to expect a distribution on Wednesday that targets what? Monday's range low or range high, depending on order flow. This right here is CRT. For those of you who have watched my entire CRT lecture, you understand this. For those of you who do not understand this, go watch it. You want Tuesday to soup Monday's range high or low into a key level on the daily chart and close back inside Monday's range. That is the turtle soup. On a classic sell day, this is Wednesday, you anticipate the 1 a.m. 4-hour candle to make the high of the day above the daily and 4-hour open with a lower time frame change in state of delivery. The 9 a.m. 4-hour candle will offer an OTE or breaker into the expansion to target Monday's range, low or high, depending on the order flow. Again, above the 9 a.m. open. It may take until Thursday to reach the target, which is why this is a short-term trading model. This is not a scalper's model. However, if you understand this, you know that time is fractal. And this very model can be designed to be executed on a low time frame. This means you can create a scalper's model. How do we execute this? Step 1. Identify the higher time frame bias and narrative. Step 2. Identify key levels where a weekly reversal can be anticipated. The key levels are drawn from the daily chart. Wait for price to take one side of Monday's range into the key level on Tuesday, and wait for Tuesday to close back inside Monday's candle. This forms a wick above or below Monday's candle. Keep in mind the opening price of the higher time frame candle. Step 3. Wait for Wednesday and look for trades within the 1 a.m. 4-hour candle and or the 9 a.m. 4-hour candle. On the 1 hour or 15-minute time frame to target Monday's opposing end of the range. So the trading times are 1 a.m., 5 a.m., and 9 a.m. Step 3. Wait for Wednesday and look for trades within the 1 a.m. 4-hour candle and or the 9 a.m. 4-hour candle on the 1 hour or 15-minute time frame to target Monday's opposing end of the range. So the trading times are 1 a.m. to 5 a.m. or 9 a.m. to 1 p.m. on Wednesday, with the sweet spots being 3 and 9:30. 3 a.m. and 9:30 a.m. Study what happens at these times. Oftentimes you will find a 15-minute range before the 1 a.m. 4-hour candle that is souped to make the high of day or low of day. Write that down and go look at your charts. Step 4, take profits. TP1 is the EQ, the 50% of Monday's range. And TP2 is the extreme of Monday's range, which is also known as the opposing end of the range. If you want, you can move your stop loss to break even only once 50% of Monday's range is reached. This means TP1 has already been hit. Step 5, your stop loss. As mentioned before, your stop loss can be placed in 4 different ways. Please rewind this video if you still don't know how to place your stop losses. The London high or low is also a good place when catching an OTE in New York. So the London high or low is a good place to put your stop loss only when trading in New York. So, taking a look at this chart right here. This is a daily chart. Tuesday takes Monday's high into a key level right here and consolidates back into the range. Taking a look at this example right here. This is a daily chart. Monday's range high right here, Monday's range low. Tuesday takes Monday's high into a key level, which is this fair value gap right here. Monday's high into a key level, and then closes inside the range. We wicked above Monday's high. We did not close above it. Wicked above Monday's high into a key level and closed back below. Where is price likely to end up? The EQ of Monday's range and then the opposing end of Monday's range. This is CRT. Dropping down to the lower time frame. On the 1 hour chart, we rally above midnight open and the 4 hour 1 a.m. open. Since we are bearish, we want to sell above these 2 opens. We got a turtle soup at around 5 a.m. This is entry number 1 to target Monday's equilibrium and then the range low. Later in New York, we rally above 9 a.m. 12 o'clock isn't necessary, however, it can be used. We want to sell above the 9 a.m. when bearish. New York will often offer an OTE or a breaker to send price lower, targeting Monday's range low. A good stop loss for New York was London session high. We have a change in state of delivery. And for London, the stop loss would be the higher time frame breaker. And yes, we did hit the OTE in the 9 a.m. 4 hour candle with a wick. This is Monday's candle. This is Tuesday's candle. This is Wednesday's candle. Monday formed the range. Tuesday formed the turtle soup on the higher time frame. Monday's range high closed back inside, wicked on the higher time frame. Wednesday's price open above 1 a.m.'s 4 hour candle, turtle souping a high, enter short, targeting the equilibrium of Monday's range, and then the opposing end of Monday's range. OTE formed during New York session, 9 a.m. open, above 9 a.m. open, and we are bearish, tapping into the OTE, measuring from this high to this low. OTE. Turtle soup. Where's your target? The opposing end of the range. Study this. the kiss of death model, KOD. The kiss of death is a continuation model where you get a last knife or turtle soup below or above a high before hitting the higher time frame draw on liquidity. Example right here, example right here. A violent move back down, expansion up, violent move back up, expansion down. This setup forms usually right before a key level is about to be hit. Step 1 when executing is to identify the higher time frame bias. Close to the higher time frame, draw on liquidity. Step 2, identify the lower time frame liquidity pool. Step 3, map out the market and candle profile with the opening price and key levels, accumulation and manipulation times. Step 3, map out market and candle profiles with opening price and key levels. Price accumulates, manipulates, that's the kiss of death, and then distributes to the draw on liquidity. Step 4, are we in a premium or discount market? You want to go long in a discount and you want to go short in a premium. Sometimes there is SMT. Step 5, target the draw on liquidity. There is no partials for the kiss of death. It is a quick move. Stop loss can be placed exactly like in the range model. This means that there is 4 possible ways to place your stop loss. So here is an example. As you can see right here, the higher time frame draw on liquidity. This is the low of Monday's range. We have an intermediate term high. We have the kiss of death turtle soup. Entry short, stop loss, intermediate term high. Take profit, the higher time frame draw on liquidity. Now I want to clear something up. Why is this an intermediate term high? Because there is a high on both sides of it. Intermediate term high. All right. Very, very simple, very, very straightforward. As I mentioned before, the kiss of death usually expands very quickly. It happens when the draw on liquidity or the key level has not been tapped yet. So price soups, Monday's high on Tuesday. That's the manipulation event. And on Wednesday, we are distributing lower. Price has still not yet hit Monday's range low. We are coming back up. Turtle souping a high. Keep in mind the intermediate term high right here. This shall not be broken. Stop loss above. Enter as soon as we tap above this high. Why? Because there's an intermediate term high on the left of us. Stop loss placed, take profit placed, bang. So how to never miss an entry? Follow this exact sequence. Entry number 1 is your turtle soup. If you miss it, then your entry number 2 is the order block or fair value gap. And if you miss that, then entry number 3 is the breaker or the OTE. Pick one. If you execute the turtle soup, don't execute entry number 2 or entry number 3. If you don't execute the turtle soup, but you execute the order block, do not execute number 3. Pick one. Elements of a high probability trade setup. Number 1, plan out the higher time frame key level. Shown here, higher time frame key level. Step 2, mark out the manipulation time using a vertical line. Step 3, mark out the pre-manipulation time. Step 4, 2 and 1 are more important than 3. So, as you can see right here, we are turtle souping a high into a key level and then dropping. Pre-manipulation time. What is this? Romeo does not go into depth about it. However, I will touch base on it. As you can see right here, we have a high, range high, range high, range low. This is the fake turtle soup. Whoever got in this turtle soup lost when price expanded higher. This is the pre-manipulation stage. Manipulate above the high, coming back down, stopping everyone out. Real manipulation event above the high and the key level. So this is why the key level is very important. So you do not get caught in the pre-manipulation stage. And then you enter short. This drawing right here looks like this on the higher time frame. Open, consolidation, high, low, and close. Open, consolidate, high, low, and close. Open, entry, exit, close. Open, entry, exit, and then close. Very, very simple. Key level dynamics. Before hitting a key level, price will oftentimes consolidate, give a false break, and a fake market structure shift with a fake accumulation, manipulation, distribution pattern. After that, the real turtle soup arrives. Take a look at this example right here. We have a fake turtle soup, fake market structure shift. Everybody is bullish. All ICT traders are bullish. Stopped everyone out. Turtle soup the low into a key level, entry at the key level, stop loss at the low of the key levels. Let's say it's a PD array, stop loss at the low of the PD array, targeting where? The EQ and then range high. Do not get caught trying to trade a fake turtle soup or a fake market structure shift. Now I will talk about another model that can be used. Romeo has touched base on this maybe once or twice in his Telegram and his Twitter. A high time frame fair value gap plus a low time frame turtle soup. This is the concept. A higher time frame fair value gap often leaves a lower time frame FVG unfilled. This strategy suggests that a turtle soup will prevent a fair value gap on the lower time frame from filling. A higher time frame fair value gap will be hit. A lower time frame fair value gap will be below us. We will form a range. Turtle soup within the higher time frame fair value gap, and we will go long, leaving that lower time frame fair value gap unfilled. That is a model in itself. The key to catching this turtle soup setup involves looking for a higher time frame fair value gap inside a lower time frame liquidity pool, while the rest of the higher time frame fair value gap remains unfilled. Example, in a 4-week, 1-month period, week 1 is accumulation and week 2 is manipulation. If manipulation enters a high time frame premium discount array, a PD array, and a low time frame liquidity pool aligning with range measurements, discount when we are bullish, premium when we are bearish, it signals a smart money reversal. That is all I will mention for this concept. I might do an entire lecture explaining how the higher time frame fair value gap plus lower time frame turtle soup actually works, because this in itself can free you and your family. Market profiles plus some more entry techniques. There are 2 market profiles available, only 2, a trending market and a ranging market. This may sound repetitive to some of you if you have watched my 9 a.m. CR model lectures and my CRT lectures. This will be repetitive. However, it is important to drill into your brain. What is a trending market? In a bullish trending market, the highs are being broken and the lows are being rejected. In a bearish market, so in a bearish trending market, lows are being broken and highs are being rejected. We are turtle souping highs and breaking lows when we are bearish in a trending market, and in a bullish trending market, we are turtle souping lows and breaking through highs. What is the meaning of consolidation? A ranging market. The purpose is to generate interest on both ends of the market and then trip one end of the range. This is the manipulation stage, allowing price to head to the other end of the range. This, of course, is distribution. Consolidation builds liquidity on both sides of the market. A clear, defined range. Turtle soup or SMT is what is used to shift from consolidation to expansion. That is important to understand. We can only go from consolidation to expansion once a turtle soup or SMT has formed. At the end of every consolidation or range, there will always be a turtle soup or an SMT. Study it. Let's talk about some keys to keep in mind. Equal highs and equal lows, as well as equal body highs and equal body lows, will more often than not be souped. Consolidations birth expansions, and expansions are followed by consolidations. Remember that the market functions by consolidating, expanding, consolidating, expanding. When you see a violent, sudden move, it is likely to be a Judah swing. Moves like these will be retraced to by 50% more times than not. The only reason price moves is to attack an old high or low. This is the turtle soup. Or 2, to rebalance an imbalance. Imbalances are highs and lows, so this is a turtle soup. Everything, and I mean everything, leads to turtle soup. This is why understanding how to trade it is so important. Rejection is the refusal to expand above a high or below a low. Whether it's an instant rejection or consolidation below a low or above a high. When in doubt, zoom out. When in doubt, head to the higher time frame. If you are unsure about a lower time frame market structure shift, head to the higher time frame to confirm it. Here are some range trading rules to keep in mind. I will repeat this: buy the range low and sell the range high. You do not buy a range high or sell a range low. Never buy the range high and never sell the range low. TP1 is always going to be 50% or the equilibrium of a range, and TP2 will always be the opposing end of a range. Some more tips. Never deal with price at the 50% of the range. Never long after a false breakout of a range. And never short after a false breakdown of a range. Keep in mind that there are some deeper intricacies of revolving around the 50% of the range. This is talked about in my previous videos. At the 50% of any range, expect a stop run, expect a turtle soup. The biggest challenge as a turtle soup trader is differentiating between ranging markets and trending markets. The only things that can help you are understanding time, using a higher time frame PD array, that is your key level, using deviations, standard deviations of a range, and number 4, chart time or experience. Use previous ranges to measure the deviations on a daily time frame. Here are some intricacies on turtle soups. So how do you trust your turtle soup? A higher time frame key level is important to trust the turtle soup. You want to be entering when the higher time frame key level is hit, not before. Understanding the different market profiles, so trending markets and ranging markets. Are we trending or are we ranging? This will determine the type of turtle soup that will occur. Understanding time. This means understanding when manipulation will occur. And ultimately, the more chart time you have, the more suitable you will, the more confidence you will have when trading turtle soup. A swing high is one of the earliest indications of a top or bottom forming. When you see a lower time frame market structure shift, you must see if it is valid through looking at the higher time frame PD arrays. If there is a bullish market structure shift on the lower time frame, but we just hit a SIBI on the higher time frame, the market structure shift is fake. The first breakout of a range is almost always a fake one. After considering rule number 1, buy low and sell high, we must look for a market maker model. If you target the low that caused the purge, you will almost always catch a trade with a very high win rate. Less R to R, of course. However, your win rate will be so high that the R to R will not matter. I will repeat this, as this can literally be all that you will ever trade and you will be successful. If you target the low that caused the purge, you will almost always catch a trade. Vice versa, if you target the high that caused the purge, you will almost always catch a trade. So, knowing this, your target number 1 will be the low or high that caused the purge. Target number 2 will now be the 50% of the range, and target number 3 will be the opposing end of the range. A strong point where we can see a turtle soup is a low above a key level. This is mentioned in month 12 of ICT's core content. Or below an old low, which is resting above a higher time frame PD array. Higher time frame for Velia plus a lower time frame turtle soup. This is what I mentioned in the previous slides. You need to understand that the way you validate a low is with a key level below it or above it. This means 2 levels will be souped, both levels of which should be drawn on your chart. The first level is the key level, and the second level is a lower time frame, low or high. The shift in market structure is only valid in 2 separate situations. Number 1, an SMT is forming at a key level, or number 2, a key level by itself. The different types of turtle soups. As soon as price starts rejecting highs and rejecting lows, this means price is ranging. If we are rejecting highs and breaking lows, we are trending, and if we are rejecting lows and breaking highs, we are trending. Here is a little cookie. Look for 3 turtle soups a day. 1 at 3 to 5 a.m., 2 at 1:30, and 3 at 4 p.m. So 1 turtle soup between 3 and 5 a.m., another turtle soup at 1:30 a.m., and a third turtle soup at 4 p.m. Sorry, I meant to say 1:30 p.m., not a.m. This would be New York p.m. session, and this as well. There are 3 types of turtle soups. 1, the continuation. This is the kiss of death, explained in this lecture. Please rewind if you missed it. Turtle soup number 2 is a range, also explained in this lecture. And turtle soup number 3, the most popular, is a reversal. When you break out of any range, the target will always be a deviation of that range. To basically understand deviations, you would take out your fib and add a first, second, and third standard deviations. I want you guys to tape read using this. When in doubt, zoom out. That means head to a higher time frame. Profile the market. And identify the types of turtle soups that form. This concludes the turtle soup lecture. Literally everything and all that you ever need to know about turtle soups was mentioned in this video. Rewatch it as many times as you need. Study it and backtest. If you study this video as you are supposed to, it will be the last lecture that you will ever need to become a successfully profitable trader. Get back to the charts and backtest and study everything that you have learned so far. Thank you for watching. And with that being said, good luck trading.